I'm going to talk about the introduction of international finance management. International financial management, also known as international finance, is the management of financial and international business environment that is trading and making money through exchange of foreign currency. The international financial activities help the organization to connect with international dealings with overseas business partners, customers, suppliers, lenders, and etc. It is also used by government organization and non-profit institution. International finance focus on areas such as foreign direct investment and currency exchange rate. Increased globalization has magnified the importance of international finance. An initiative known as the Bretton Woods system emerged from a 1944 conference attended by 40 nations and aimed to standardize international monetary exchange and the policies in a broader effort to nurture post-World War II economic stability. Trade issues occasionally dominate and are a continuing theme of the international scene. The global market, sweatshops, child labor, trade deficit, the euro sanction, tariff embargoes, and the EU, NAFTA, WTO, the seemingly endless alphabet in the interest group, treaties, organization, and trade agreements.
Managing foreign exchange risk. The foreign exchange market, sometimes known as the over-the-counter market, is a global decentralized or over-the-counter market for currency trading. Every currency's foreign exchange rate is determined by this market. It encompasses all aspects of purchasing, selling, and exchanging currencies at current or fixed prices. Unanticipated exchange rate changes can have a negative impact on companies' value, which is known as foreign exchange risk. If a company is doing a business utilize contracts in other currencies, they will be exposed to the risk of exchange rate swings having unfavorable consequences early on. Three types of foreign exchange exposure that are multinational corporations have been recognized by experts. Transaction exposure as a short-term exposure. The second one is economical exposure, that is for long-term exposure, and the last one is translation exposure, are the three types of foreign currency exposure. Next, I will present about problem and solution in managing foreign exchange for e-Sulam. We are all aware that there are numerous problems involved in handling foreign exchange risk. Among them, all of the losses that our international financial transaction will incur as a result of currency fluctuations. Investors who trade on international markets may be affected. Not only that, firms that sell items or services both domestically and internationally will be affected too. There must be a way to prevent this problem happen is by all international businesses have to look to the currency level of each company and country that you want to invest. The types of every international business company must check before invest are example like a company or country must have a strong and rising currencies. In other words, level of currencies that are strong relative to your own domestic currency is really important and should always be observed. Historical with low debt to gross domestic product GDP also can be used as a measure of level currencies of a business.
Managing foreign exchange exposure related to one more errand that monetary officials of worldwide organizations perform to managing working capital or money balances. All the while, they should adjust three corporate monetary objectives which are minimizing working capital balances, minimizing currency conversion costs, and minimizing foreign exchange risk. Firstly, the corporate monetary objective is to minimizing working capital. Monetary officials try to limit their association working capital adjust. Both homegrown and global firms should halt churning out capital for two reasons, which are to work with everyday exchange and to cover the firms against startling requests for cash. Next, the corporate monetary objective is to minimizing foreign exchange risk. Monetary officials additionally commonly change the blend of monetary standards that make up the company's function cash flow to limit unfamiliar trade hazard. Frequently, firms utilize a select procedure to attempt to expand their net positions of money, standards that are relied upon to extend in esteem, and to diminish their net property of monetary standards that are relied upon to fall in esteem. As the conclusion, this chapter presents a summary of the main terms of the preceding chapter. It presents the following principles to guide in the design of the new international financials. Full cognizance of the social costs of the internality of system risk is needed, particularly its macroeconomic impact. Homogeneity of market behavior is a threat to liquidity, particularly at time-high volatility when conversion has broken down. Steps need to be taken to reinforce the stabilizing powers of conventions. International policy formation and implementation should be international in scope because financial markets are today international. International decision-making and standard setting should be effective in devising principles of efficient regulation. accountable in terms of transparency and clear lines of decision-making authority.
Sources of international investment. To allocate money, firms will usually use capital budgeting techniques. This is because such a method can lead to domestic and international projects that can promise high returns. Firms need to identify which opportunities are most lucrative, but before that, each firm needs to have enough capital to fund either external or internal risk. Every international business definitely wants to minimize the unexpected foreign exchange risk, not only the risk but also the political risk as well as the global tax burden that it has to bear. For sources of international investment, there is two options. That is, first is external sources of investment capital, and the second one is internal sources of investment capital. Strategic use of transfer pricing. Transfer pricing establishes prices for goods and services swapped between subsidiaries or enterprise under shared management that are all components of the same bigger organization. Corporation can save money on taxes by using trick practices while tax authorities may challenge such as claims. There are two types of transfer price calculation. The first one is market-based method and the second one is non-market-based method. The next one is tax haven. This tax haven offers foreign businesses and individuals several types of tax, that is minimal or no tax liability. This is because the factors of a stable economic and political environment play a role in this. Not only that, in this tax haven, we will be able to see the tax advantages for companies and rich people. These have great potential to commit abuse in illegal tax evasion scheme. Multinational corporations will also get benefit from this because they will be able to establish totally owned subsidiaries in the taking area. Multinational firms can use tax havens to shift income from subsidiary subject to high national taxes to subsidiary operating in tax havens. To attract multinational firms, a tax haven must offer a stable political and commercial climate, an effective legal system, and advanced banking and communications industry, in addition to not charging income taxes. In exchange, the tax haven is able to collect franchising and incorporation fees as well as create high-paying professional positions. The last one is I will present about problem and solution of sources of international investment for Islam. There will undoubtedly be issues with foreign businesses transactions. The higher transaction expenses are one of the issues that will develop while investing in the international market. We live in a larger global society and transaction fees vary significantly depending on the foreign market you intend to participate in. They may be additional charges relevant to the local market in addition to the higher brokerage commissions. Stamp duties, levies, taxes, clearing fees, and exchange costs are examples of this. The process of selecting overseas investment, time and money spent on research and analysis. Hiring market analysis and researchers, as well as other specialists with experience in international financial statements, data collection, and other administrative service could be part of this. There are few ways to reduce expenses and so control the problems. Every worldwide company must develop a strategy for evaluating its operation and determining where it wants to go in the future. To adequately predict expenses and account for contingencies, roadmap is required. In other words, businesses need to track expenses diligently to understand our historic costs before planning the best action for our future business.